This is level 1 of the CFA program, the topic on economics, and the reading on aggregate output, prices, and economic growth. Economics is almost always divided into at least two subcategories. The first one is microeconomics, and we've already had a reading or two on microeconomic principles. How about if we think of me as Jim as a Honeycrisp apple farmer, and I have a bunch of Honeycrisp apple trees in my backyard. Suppose I can harvest 10,000 apples and I can sell them for $1 a piece. So we have a supply and demand curve for my particular kind of market in my backyard. Now, of course, I don't live in a vacuum, and I have competition. And so suppose that there are lots and lots of other Honeycrisp apple farmers out there. The second part of economics is macroeconomics, and what we're trying to do here, among other things, is to look at things like aggregate supply, aggregate demand, and aggregate output. And so maybe in the aggregate, all of us Honeycrisp apple farmers can produce, let's say, 1 million apples, sell them at $1 a piece. And so the question then becomes, what's the difference between the micro study, which is of individual consumers and businesses, and how they match prices and supply and demand, and then how that occurs at the aggregate level. And you'll see that as we go through these learning outcome statements. So look at the first four. They all have GDP in them. So we need to do some comparison. We need to do some calculations. And we need to look at GDP, which we know is a measure of the output of a particular economy. In my example, it's just the output of Honeycrisp apples. But let's go ahead and include things like smartphones and automobiles and sneakers and houses and computers and everything out there. If we add everything that individuals and businesses buy and sell, we get some measure of productivity. We call that gross domestic product. Then we'll go ahead and look at an aggregate demand curve and an aggregate supply curve. We'll look at movements along and shifts. We'll go ahead and talk about recessions and inflation and equilibrium. And then we'll end with just a few slides on the production function. So I want you to think about this macro as a natural extension of everything that we talked about in micro. Now we're doing it at the aggregate level. So that first LOS asks us to explain gross domestic product. I'm guessing that the calculate portion of this LOS is probably not too terribly important, but if you have to calculate, you can use that simple equation that we have in parentheses right there. But let's go ahead and look at that definition. Total market value of goods and services produced in a country, and of course this is over some time period. I mean, it could be a day, it could be a month, but generally GDP is announced quarterly and then annually. Look at that second line. GDP is frequently used as a measure of total size of a given economy. And so it consists of a couple of different input variables: consumption, investment, government spending, and then the X minus M. Those are the difference between exports and imports. Two ways to compute this: the income approach and the expenditure approach. And notice at the very bottom we say that these methods should arrive at the same value. But what you'll see as we go through these equations is there's something called a statistical discrepancy that kind of forces these two methods to approach each other, if not in exact identity, if at least in some reasonable sense. Now remember, here in the United States, the total size of our economy in 2021, it might be $22 trillion or $23 trillion. So if you're off by, a couple billion or tens of billions, it's really not that big of a deal. So let's look at the income approach first. Aggregate income earned, that's the key word there, earned by all households and companies during a specific time period. Now the reading tells us that the GDP, according to the income approach, is equal to something known as the gross domestic income. And so that's just kind of a definitional term. Go ahead and look down at the bottom there, gross domestic income. And so how do we make money? So compensation of employees, so there's income from individuals, and then gross operating surplus, that's probably something like profits made by businesses. And then gross mixed income. Remember that someone like a financial institution has interest income and interest expenses, and so that's probably the gross part of there. And then we've got taxations and subsidies, because the federal government comes in and says something like, okay, if you do this, we'll tax it. If you do that, we'll subsidize it. So we need to consider all of those things. But look at that arrow point in the middle. It's the sum of all wages plus rents plus interest and profits. Notice in the gray box there is a notion of statistical discrepancy. And then the expenditure approach, this is what we're doing here. Let me go back here real quick. So this is almost like looking at a business on the right-hand side of the income statement, right? The revenue kind of thing. And this is looking at it from almost like the left-hand side of the income statement. So consumer spending on goods and services, gross fixed investment. These are all the investments in positive net present value projects. And then, of course, there's working capital management, and that includes the change in inventories, government spending, government investment. And then notice the second to last one there, exports minus imports. So we need to concern ourselves once again how much we're making or servicing here in one country and how much we're exporting that to another country versus the number of imports that occur. And then, of course, there's that statistical discrepancy. So, the interesting thing, at least from an introductory economics textbook standpoint, is that, you get these two numbers and, suppose they're 21 trillion and 20.5 trillion, and that the statistical discrepancy here and here kind of equilibrates the two. I'm not sure that equilibrates is a word, but I think you get the point. Let's go ahead and compare value added and the value of the final output. And I think this is important from not only an LOS perspective, but also from something that I'll mention here in just a second. So hold off on this. So look down the left-hand column. We start with the farmer, sells wheat to the miller, to the baker, to the store, and then finally to the customer. And so the sum of the value added is the 40 plus the 50 plus the 20 plus the 30. So that gets you up to a total value on the expenditure side of $1.40. So this would be the output sum of value added, as opposed to the value of the final output. All you really do is take a look at the final selling price, a loaf of bread to the customer, $1.40, and of course you're going to arrive at the same value. Notice the bottom arrow point, sum of value added, has more granular details. So there's a really fancy word that's very popular over the last handful of years. And of course, granular meaning that you can go back and you can see exactly what that value is captured at each step of the manufacturing process. Now, I think this is a really cool thing to learn, not just for the LOS perspective, but from a tax perspective. Here in the United States, there are politicians who are talking about a value-added tax, which sounds like kind of a cool thing. But what happens is that at each step, going down the left-hand column, there is a tax imposed. Now, lots of countries out there have a value-added tax, and I won't editorialize about my being in favor or not in favor of a value-added tax. However, if you lump all of these taxes inside of the granularity, at the end you're probably going to come up with a higher effective tax rate. Boy, we can't talk about GDP, we can't talk about the economy either at the micro or the macro level without mentioning something about inflation. So let's compare nominal and real GDP. So nominal GDP simply means, okay, what was the total value? But then real GDP is what is the change in value in real terms, like in the absence of inflation. What would GDP be if we didn't have rising prices. Those of you who are paying attention in 2022, you'll know that gasoline prices are rising. So of course, GDP is going to increase because the gas stations are now generating more revenues, right? And they're probably paying more, some kind of a corporate tax or a business tax on that. So the economy is probably growing. However, what's most likely happening is that we're probably filling up less and less. And so the question then becomes, what is the real GDP? And so note that last arrow point, holds prices constant to separate actual real growth from inflation. And here's a super simple example here. Let's suppose that we have an automaker selling 1,000 cars, 20,745, and then the following year the automakers sell 1,000 cars at 21,175. And so the question is, did the economy grow? Well, if you look at it on the pricing side, of course the economy grew from the 20,000 to the 21,000, I'm rounding there. But did the actual number of productivity in terms of cars sold grow? Well, 1,000 equals 1,000. So the question is, well, how do you address this if you're the government trying to keep track of total output? And so all we're going to do here is take that 21,175 and divide it by the 2745, and we're going to get 2.07%. So that's going to be kind of our rate of inflation. So there's the formula at the bottom for the GDP deflator, the 102.05. And what that does, of course, that results in 2.07% growth in GDP. But look at that second circle point. In real terms, we know there was zero real GDP growth because we sold 1,000 and then we sold 1,000. It just happened to be that inflation in the car market was 2.07%. We need to distinguish between this concept of personal income and disposable income. So personal income is all that household income in the economy, both earned and unearned, whether it's through wages or lottery winnings or consulting fees or royalties. And so what that personal income does, and that's important, look at that first arrow point. It represents the purchasing power of consumers. Now we need to pause and take a listen and take a look at the personal income over time and how inflation might appear to be increasing the purchasing power just because income is going, but it depends on some other factors that we'll talk about not only in this slide, but in future slides as well. Personal disposable income, on the other hand, is all personal income minus personal taxes. And so this measures household purchasing power after all taxes have been paid. And so this is super important because let's suppose that I make $1,000 this week. Well, it might sound like I can go out and spend $1,000 on, what do I spend my money on every week? I have a mortgage, I have gasoline, right? I have to eat, I have children, and my wife and I, we have to pay for, maybe some entertainment. Maybe we're paying for Hulu to watch that Steve Martin and Martin Short fantastic show that we've been watching. So we have all these things. But on the other hand, suppose that when we bring that $1,000 personal income home, we get a thing in the mail that says, dear federal government person, you need to pay $1,000 in taxes this week. So if I have to pay $1,000, then I have no money available to spend on goods and services. So make sure you have the difference in your mind between personal income and disposable income. Now, one of the main factors of a study of macroeconomic analysis is to ask yourselves the question, all right, I have this income, I have this disposable income, what can I do with it? Well, I can save it, I can spend it, I can invest it, but what's happening here inside of the way the government keeps track of this is that investment is a form of spending. And so there's that formula again that I had just briefly in one of those earlier slides. So there's GDP. So we've got consumer spending, we've got investment on the business side, we have government spending, and then either the trade surplus or the deficit. And so this is important here. Money saved does not flow into that equation. So it's not part of the GDP growth. However, the savings can be absorbed into several things. It can go into investment. So think about saving and going down and buying a certificate of deposit, and then that eventually gets to some kind of a positive net present value project. It can also finance government deficits, and it can also finance trade deficits. So the savings equation at the bottom there, and this is important to address this LOS, it's going to be that investment plus the financing of the deficits plus the trade deficits. Now, what you can do is you can rearrange that to focus on fiscal deficits. So just do some super simple algebra, and you get, on the left-hand side, you get that fiscal deficits, and then savings minus investment, and then the trade deficit as well. All right, let's go and switch and go back to my Honeycrisp apple example. So I'm the apple farmer, and I have my unique supply and demand curve for my backyard. But now we need to consider everything that's out there. Aggregate demand represents the quantity of goods and services that households, businesses, and governments want to buy at any given level of prices. All right, so not only are we thinking about the market for Honeycrisp apples, right, but we're thinking about how the market for Honeycrisp apples then reflects all of the market for all different other kinds of apples, all different other kinds of fruit, and then all different other kinds of food, and then goods and services. So aggregate demand is aggregating all that stuff. We start with my one Honeycrisp apple in my backyard, and we lead to the entire economy. All right, so let's go through some of these bullet points. Aggregate demand curve, combination of aggregate income and price level at which two conditions are satisfied, right? Quantity demanded increases as the price level declines. That's the same as we had at the micro level. And this downward slope is the result of three effects. And so let's go ahead and look at the wealth effect, which we probably know and makes perfect sense. When the price rises, the number of products and services that can be purchased with a fixed amount of nominal wealth, it decreases, of course. Makes perfect sense that in real terms, we are less wealthy. So that's the wealth effect. The interest rate effect, on the other hand, is that as prices rise, this is the definition of inflation, somebody out there is going to say something like, you know what, if inflation is increasing and it's expected to continue to increase, I demand protection against inflation. So if I'm out there and I have capital, whether I'm a financial institution or just some wealthy investor or maybe even the federal government, if I have capital and someone wants to borrow from me, I'm going to charge them an inflation premium. So what happens then is that interest rates rise. So the interest rate effect is that when prices rise, inflation rise, and then interest rates follow. And of course, it could be as simple as investors demanding that inflation premium, but it could also be as complex as the federal government coming in and raising interest rates, whether it's the discount rate or the federal funds rate here in the United States or any other rates throughout the world that is controlled or at least influenced by central banks. And so, of course, when interest rates rise, what happens? Businesses are going to find fewer and fewer positive net present value projects, so they invest less. Borrowing costs rise, of course, there's less productivity in the economy. The real exchange rate effect has everything to do with rising prices making domestic goods less attractive to consumers over in other countries. And so, well, let's just take a 2022 example when gasoline prices here in the United States have gone from an average of, I don't know what they were a year ago, say $2.20 to in the middle of 2022, they're now $4.50 or $4.80. Well, I don't know, what was that? Maybe they've doubled. Well, there's no way that somebody from Canada is going to drive to Wisconsin or Michigan or New York and say, fill her up, right? So the goods and services here in the United States, as a consequence of inflation, are less attractive to consumers in other countries. Now, of course, you don't have to be in Canada and drive to the United States to get gas. I mean, you could be living in Europe and you could want to buy something that's manufactured here in the United States, and you just hit a button on your smartphone and you can import it. But you're going to be less likely to do it if that price is rising. And so what happens then, that the real exchange rate then is going to be impacted because Canadian consumers are going to be less willing to exchange their Canadian dollars for US dollars to buy the gasoline or the smartphones. And so that real exchange rate changes and it impacts the GDP. Let's go ahead and look at the supply curve. So what do we remember from our microeconomics days? You remember that supply curve looks like this, right? And also remember, it was a lot of times it was the marginal cost curve. Remember, there was that crooked kind of a smile where you had a little smirk down here on the bottom left, and then it went all the way upward sloping to the top right. But now we need to add the element of time when we're aggregating these elements. So let's go ahead and start with the long run aggregate supply curve. And this is interesting because what we know is that in the long run, there are no fixed factors of production. All input factors become variable. And that's an interesting kind of a result and an assumption. But look above the blue box there. Let me read that to you. Aggregate supply represents the amount that domestic producers are willing to produce at each price level. So it makes sense that it's upward sloping, because if I could sell my apples at $1, then I'm going to plant a certain number of Honeycrisp apple trees. But if I could sell the same number of apples at $10 an apple, man, I'm going to go out back and I'm going to plant those trees, and I'm going to hire Jack and the Beanstalk to come out and put his little magic potion on there so my Honeycrisp apple trees grow really, really quickly. Look at that third bullet point. So long run aggregate supply, it is a static value. And we're going to see that when we look at the supply curve in just a second. Now, the short run aggregate supply curve is going to be super simple. It's going to be quantity supplied increases as the price rises, which means that when prices are rising, that pretty much implies that as a good business, we're going to search for that extra profit margin, right? So if we can keep, you ready for this? If we can keep our wages constant, if we can keep our other input costs constant, then we can capture that extra increase in prices as net income to us. So those higher prices, they initially then justify an expansion of output. So this has everything to do with capital budgeting and the positive NPV projects that we talk about in the corporate finance topic. But then of course, we learn that our employees are going to say something like, hey, you know what? We see you're making a bunch of money over there. We see that prices are rising. We want to share in that. And so, of course, the firm then increases wages and increases more labor hours. And so that's going to increase that expansion. And we're going to have higher productivities, which then, you think about it, then the economy ought to expand. Here's this graph that I promised you a moment ago. Notice that the long run aggregate supply curve is perfectly vertical. It is perfectly inelastic, which simply means that when all of the inputs are variable, that it is going to be the price level. It is the price level that's going to determine what our profitability is. No matter what the price level is, we're going to produce at that long run average supply curve, whatever that is right there. And notice we have real GDP on the horizontal axis. The short run aggregate supply curves, however, those are the green ones there. Those, of course, are upward sloping, and we can have movements along, which we'll talk about in a minute, or we can have shifts from one green to another. And so those short run aggregate supply curves, they are going to shift in response to increased prices. And so if prices are going up, then we're going to shift that curve in response to that change in price. Then, of course, don't forget the downward aggregate demand curve. That is in red. Now let's go ahead and distinguish between shifts and movements along. And so this is a good slide to remember. And what I'm going to have to do is go through each of these arrow points a little bit slowly so you make sure that there's probably some time that goes by. These are not instantaneous reactions. All right, so what is a movement along the aggregate demand curve? As the price level increases, all right, so as that price goes from $2.40 a gallon of gas to $4.50 a gallon of gas, then the real money supply declines, right? Because of that increasing in inflation, then interest rates are going to increase based on what I said earlier. That means that firms will find fewer and less and maybe no positive net present value projects. So investments then decline. And then, of course, if firms are not investing out there, if they can't find positive net present value projects, then they're going to have to start doing things like laying off employees and lowering their wages, so level of incomes decline. So this will essentially result in a tendency for the economy to contract. I'm not saying that this is going to result in a recession. We'll talk about that in just a few minutes. But clearly, the elements are in place for some type of a contraction. Now, movements along the aggregate supply curve when the price level increases. Now, we talked about this. Business profits increase, right? And then businesses increase production. So those are probably relatively short-term responses to a price level increase. And that should make perfect sense. But then imagine if in my Honeycrisp apple example that the price, it was $1 and then all of a sudden it's $5 and all of a sudden it's $10. Well, what's going to happen is that tons of people are going to start planting Honeycrisp apple trees, which means that supply is going to dramatically increase because all these firms are chasing those higher prices. So then eventually, can I say eventually? And I don't know what eventually means. Now, clearly, with my Honeycrisp apple example, you can't plant a tree and have it harvest overnight. So there's some time lag in there. So prices will decline and then businesses will reduce production. And this has everything to do with things like the business cycle. And this is a part of the business cycle that we've learned about back in the micro, and we'll talk about it again here in the macro, that relates to changing prices and contractions and expansions. Now, this slide is a slide that tells us about shifts in the aggregate demand curve as opposed to movements along the aggregate demand curve. So make sure you have this differentiated in your brain. So what's going to cause that aggregate demand curve, right, downward sloping, what's going to cause it to shift outward, increases in demand, or shift leftward, decreases in demand? And these should make perfect sense here. I shouldn't have to go through these in too much detail. Household wealth, consumer and business expectation, capacity utilization. All right, so what does this simply mean? That means that if businesses are making investments in positive net present value projects, and that probably means that those employees are generating more of a household income, and hopefully tax policy is not too onerous that it's reducing disposable income. So we'll go ahead and make the reasonable assumption that income and disposable income is increasing. And along with that, if businesses are expanding, then that news seeps out into the economy and everybody says something like, oh boy, do you see that business over there? They're building a big building over there and they're going to expand. They must know what they're doing. They must be making a lot of money. They must be optimistic about their future. And so if you have optimism over there and optimism over there and optimism all around, then consumer and business expectations are going to rise. And then that's going to cause that outward shift in aggregate demand, an increase in the aggregate demand. And of course, just the reverse holds true, that if everyone's depressed, if no one's working, no one's making any income, businesses are shutting down, well, then that aggregate demand curve is going to shift leftward. So those first three embedded circle points, those have everything to do with individual households and then businesses, and then the resulting change in expectations from all of this investments and how all the investments pay off. And then, of course, the final three have everything to do with that third group of people out there, the federal government. And so the federal government, of course, has an influence about how individuals and businesses behave, right? Governments, they have tax policies, they have rules and regulations that are designed to achieve an outcome. And that outcome might be a good outcome, but there's always, these unintended consequences. So fiscal policy. So what can the government do? Government could increase expenditure. So the government could come in to my city and they could say, hey, you know what? Jim's city, it needs a new bridge over here. It needs a tunnel over there. It needs a new sports park over there. It needs a new school system over there. Here's all this federal money. Here's let me just pick a number, $100 billion coming into Jim's city. And so what happens? Everybody in Jim's city is saying, wait a minute, I'm going to go over there and work because I can double my income. I'm going to go over there. Look at all these people. So everybody is super happy. Everybody in Jim's city is making tons and tons of additional income, and this spills over to businesses too, because there's a company out there called let's call it Dave's Construction Company, which is going to help build all of this stuff. So fiscal policy can play a huge role in shifting aggregate demand to the right or to the left. And then of course central banks with monetary policy, central banks could wake up tomorrow morning and say, you know what, I don't think interest rates are high enough in Jim's city. I'm going to raise them to 50%. And so all of a sudden we all wake up and we say, wait a minute, if I need to borrow money to buy a car, I have to pay 50% or 60%, or to take out a mortgage loan, I have to pay 60% or 70%. So that money supply is going to shrink immediately, and no one is going to be happy about that. And then of course the result of those first 5 embedded circle points are going to have an impact on exchange rates. Remember, if here in the United States, if everything is going well, if we're finding positive net present value projects, if incomes are rising, if we're approaching 100% full capacity, if the Fed and Congress is doing reasonable stewardship of our capital, then other countries are going to say, hey, I want a part of that. So they're going to convert their foreign currency units into US dollars, and they're going to demand US dollars, taking US dollars out of the foreign exchange market. And so the US dollar is going to become stronger, and that's going to impact GDP here as well as GDP in other countries. Now, how about shifts in that aggregate supply curve? So remember, that's upward sloping. And then, the long run, it's perfectly inelastic. But let's focus on the relatively short run aggregate supply curve. So nominal wages, of course, this tends to decrease production. Higher input prices then tend to decrease production, right? Taxes and subsidies tend to decrease production. And, so you have this battle between, all right, inflation is good for businesses because if they can capture the higher prices, then they have a higher profitability. But if wages are following that along, and if other inputs, like raw materials and natural resources, if those are following along with inflation, in fact, if those inputs and wages are rising faster than the consumer price index, let's say, well, then you have shrinking margins, and that's going to probably tend to lead to a contracting economy. So remember that this inflation, it's, kind of the double or triple edged sword, however many edges you can get into a sword. But look at the bottom circle point down there. High productivity and technological innovation, that's going to increase production. Wow. That's all good stuff. And here's pretty much a summary of what I've been describing about the business cycle, changes in the short run value of GDP. So economies can expand, economies can contract. Clearly, expanding economies mean that GDP is increasing. It means that more people are working. And it means that firms are finding all of these wealth increasing projects so that they're filling up more and more of their factories, not only with more workers, but are you ready for this? Hopefully, more efficient workers and more machinery. And are you ready for this? Hopefully, more efficient machinery. So what that capacity utilization increasing phrase implies is that firms now, since they're generating higher profits, are able to get rid of obsolete machinery and machinery that doesn't work very well. And then, of course, with the contraction, you just have the opposite. Let's go ahead and continue our discussion of the business cycle, and that's a part of this LOS. And so what we're going to do here is we're going to go ahead and take a look at shifts in these curves, and we're going to take a look at it from, here I'm going to scroll through this really quickly and then I'll come back. A recessionary framework, an inflationary framework, and a stagflation framework. All right, so what we're going to do is take a look at each one of these consequences to typical changes in the business cycle. All right, so let's go ahead and start with a recessionary gap. What we know then is that if there is a shift in the aggregate demand to the left for, here, let me go back here, for whatever one of these reasons, whatever one of these, or combinations of these reasons, we have a shift from the left. So we go from the green to the other green, aggregate demand. Now, what's going to happen? Notice that the price level falls, right, from P1 to P2. Wow. Which means that if we have falling prices, then that productivity output for the firms are probably going to decline. So GDP is going to fall. And then look at that last circle point. Corporate profits, employment, commodity prices, interest rates, and demand for credit is probably going to decline. Now, they're probably not all going to decline by the same amounts or the same proportions, but nevertheless, this is called a recessionary gap, which doesn't have to result in an actual recession, but it will very likely result in a contraction, maybe for 1 quarter, a contraction of the economy. That is the recessionary gap when there is a shift in the aggregate demand curve leftward. All right. What about an inflationary gap? This is when the aggregate demand curve shifts outward and to the right for a variety of reasons that we had on that earlier slide. I won't swing back again, but what's happening here is that we go from price A to price B. What is that? P1 over to P2. So we have this gap between A and B, which is the increase in prices because the aggregate demand curve has shifted. And so that inflationary gap is going to lead to probably some increases in employment, probably productivity increases. And so all those things that were negative in that previous slide are going to turn positive. So profits, employment, prices, and interest rates, all of those things rise. And so look, that inflationary gap here is real GDP on the horizontal axis. That gap is productivity from the Y to the Y on that horizontal axis, which is, here, let me go back here. That recessionary gap then is from the Y2 down to the Y1. So think of recessionary gap as the difference between the long run aggregate supply curve and the new equilibrium price at point B, or what is that, at P2. Here, the inflationary gap is the difference between the long run aggregate supply curve and that new productivity, which is what, Y1. So think of that gap as between inflationary gap or recessionary gap as the difference between the long run and the short run. Stagflation, on the other hand, is this interesting concept. We've heard about this over the years. If you're regular readers of the Wall Street Journal, you'll know all about this. Those editors at the Wall Street Journal, they are super smart. And so this combination of stagnation, meaning the economy isn't really doing anything, but there is inflation. And look at the very bottom bullet point that we've put in there so succinctly. It's very costly. Of course, nobody likes this. And difficult to address, which means that if I went back to that earlier slide, right, the fiscal policy and the monetary policy, when there's stagflation, government officials are, pretty much doing this, shaking their head, and they're saying something like, okay, well, you guys have any ideas out there? What can we do? So look at that third circle point. The price level increases because of inflation, but production and employment either stays the same or they fall. And so severe stagflation is when you have rising prices and nobody's working and nobody's producing anything. So this doesn't sound like anything but trouble for the economy. All right, types of macroeconomic equilibria. All right, so let's talk about long-run full employment. This is when the aggregate demand curve, so there's the blue line there, intersects with the short-run aggregate supply curve right there, where it intersects along the long-run aggregate supply curve, and that's that equilibrium price on the vertical axis. And so look at the second point. Capital and labor are fully utilized, which means that this concept of potential and equilibrium GDP are equal in long-run full employment. Now, let's just pause here just for a second and take a look at the last, let's say, 20 years of economic growth. Not only here in the United States, but throughout the world. Have we had long-run full employment? Well, there have been periods where U.S. employment rates have been super low. However, the participation rate in the labor market has not been super low. That thing has been growing. So in order to get to this long-run full employment level in this ideal picture here, you need to have everybody who wants a job has a job. Not only that, but everybody who wants a job has the job that they want. Now, of course, what we can do is take a look at short-run recessionary gaps and short-run inflationary gaps, and these are going to be exactly similar to what we just did before. So let's take a look at the top graph, top illustration up in the top right. So we have a leftward shift in the aggregate demand curve, and so price levels and GDP levels decrease, and so companies reduce production and employment. There's the short-term recessionary gap. On the other hand, short-run inflationary gap is just the opposite. We have a rightward or an increase, shift in the aggregate demand curve, and then price levels rise, and then companies increase production and employment. Short-run stagflation, on the other hand, we have a leftward shift of the aggregate supply curve. There's the arrow there from one of those reds to the other reds. Price levels increase. Of course, the price level increase. And employment falls. Economic growth slows while inflation increases. So remember, this stagflation is always a combination of either a stagnant economy, but the reading pretty much emphasizes that this is a contracting economy while prices are rising. Look at this LOS. Short-run macro equilibrium, it might occur at a level above or below full employment. All right, so this is interesting. So short-run macro equilibrium occurs when the aggregate demand curve intersects with the short-run aggregate supply curve. We know that, right? So what happens if we have a decrease in aggregate demand? So think about my apples out there. My apples are just part of the entire economy, but this can be a component. So as the price level falls, I'm probably going to employ fewer people. And if I'm employing fewer people, and if my price level falls, then probably the price level for Honeycrisp apples in the entire market is falling, and Can I go ahead and continue saying this? Probably the prices of all other commodities, apples and kiwis and bananas and grapefruit, they're probably falling. Commodity prices are falling. And then maybe prices of smartphones and computers and cars are falling, which means this aggregate supply is going to fall. Those input prices then fall. And then some businesses then say something like, hey, you know what? Since I can hire workers at a lower input, I can have access to these raw materials and natural resources at lower input. So those input prices fall, then businesses are going to start investing again, increases the supply, right? So new equilibrium has the same output, but lower prices. Now, how about if we look at an increase in aggregate demand? So that output level becomes greater than normal price levels, right? Suppose that for some reason, one of those reasons that we've talked about so far, that people really love my apples. Hey, Jim's Honeycrisp apple, the greatest apples ever. And that leads to an increase in aggregate demand, not only for apples, but for grapefruit and kiwi and for smartphones. So we all have to hire more people. So employment then increases above those normal levels. And then we probably, look at that last teardrop point, we probably have inflation. We have a decrease in the short run aggregate supply, those price increases as the supply decreases. And all this means is that the output levels fall as the input prices go up. And that should make sense, right? And then maybe just the opposite, an increase in short-run aggregate supply. Just turn that upside down. Now, every once in a while, we put together a really good summary slide, and I asked the candidates to get out their phone and take a picture. I'm going to go ahead and do this. So this is a summary of what we've talked about. So just take a picture of this and put it in a file called, CFA pictures that Jim recommends, and then you can just scroll through those when you're on the train or you're in the library or wherever you are. You can try to memorize these things. So that's a summary of what we've been doing. This is an interesting LOS. Let me read this to you. Analyze the effect of combined changes in aggregate supply and demand on the economy. So what do we know? We know that the economy is dynamic. We know that it's possible to have aggregate supply curves shifting and aggregate demand curves shifting, and they can be shifting for similar reasons or completely different reasons. And so here, these are the 4 good bullet points that summarize those changes. Since you have your phones out, you might want to take a picture of this slide as well. So if both aggregate demand and aggregate supply increases, this will probably increase real GDP. But the impact on price levels depends on, and notice what we have in each one of these bullet points. This is really good. This is really good illustration. It depends on the relative magnitude. So I'm going to do this just once. And then you can relate this to the other 3. Look, if you have, here's aggregate supply, and it shifts outward by this much. Oh, you didn't even see it. It just shifted this much, right? So you can barely see it. So it's a shift in aggregate supply. But here we have aggregate demand, and the aggregate demand goes like this. Can you even see my hand in the camera? So of course, then the aggregate demand change is going to dominate the aggregate supply chain. And so as you're reminding yourself before the exam, make sure you have that relative word bolded in red like we've done here. All right, if both of them decrease then of course relative GDP decreases, but the impact on the price level depends on the relative magnitude. Oh boy. And so how about if we have one going up and one going down? So if the aggregate demand increases and aggregate supply decreases, so those are two motivating forces that are going to increase the price level. So that's important. So notice we have this. The price level will increase, but then the impact on real GDP depends on the relative magnitude. And then of course we can just flip that upside down. All right, let's move on to some of these final LOSs. Describe sources, measurement, and sustainability of economic growth. All right, so this is important, and you probably remember this. from a microeconomics and a macroeconomics class that you had a long, long time ago. But these are obvious answers here. But measurement and sustainability of economic growth. So there's that important word, sustainability. Remember when we did stock prices and we talked about sustainable growth in that Myron Gordon growth model. So sustainability means something like, all right, are the forces in the economy as they're changing, right? Aggregate supply or aggregate demand, are they changing? Are those non-transitory, right? I hesitate to say permanent because no change in the economy is going to be permanent. But of course, if we have good things happen to the economy and the economy is expanding, can it be sustained? Can it be sustained for extended time periods? In other words, can it be sustained so that we can avoid these short-term economic contractions? And so think about sustainability as strength, core strength of the economy. All right, so let's go through these one at a time. So sources of economic growth, physical capital stock. This makes perfect sense, right? If we have more equipment, more machinery, more buildings, that probably is the result that we found wealth increasing projects. And so notice we have there increases annually as long as net investments are positive, right? So increasing physical capital stock. Just think of positive net present value projects. Labor supply, number of people that are available to work, human capital. I mean, I think of myself. And I think of, all right, how smart was I? How smart was I back when I first got my PhD? My accumulated skills and knowledge. How old was I in 1993? I was, 32 years old, 33 years old. This is how much I knew back then, but this is how much I know now. So the human capital for me, and I'm guessing that you guys over your learning curves with your careers have figured out that you're much more valuable today. Of course, the opposite of that is that the more I learn, the more I realize that I don't know anything about anything, especially about parenting. Natural resources, and this is a huge issue, right? Renewable natural resources versus non-renewable. So we have this big debate over, boy, should we leave the oil and the coal in the ground, or should we use it to have, relatively cheap sources of energy? That's not the conversation we're going to have today. Nevertheless, those natural resources, those are a tremendous source of economic growth, whether renewable or non-renewable. Technology, this makes sense. Right. When I was in college, not only did I not have a smartphone, but I didn't even have a personal computer. Those things were they were being invented when I was in college. And so I had none of that stuff. But nowadays, you press a button and all sorts of crazy things happen. And then infrastructure, that's an important word that you hear from politicians all the time these days. So road systems and water systems and airports. Notice that in the very last bullet point, we have infrastructure creates externalities. And this is awesome. An externality that complement production so that if let's suppose, envision a scenario where, there are two nearby cities that are separated by, maybe a river or a small river, and there's a bridge, and that's a 2-lane bridge, and so the cars, they putz when they go across the 2-lane bridges, and so the government comes in and says, we're going to build an 8-lane bridge, and so the 8 lanes, so now we got 4 going that way and 4 going this way. There's an externality in which productivity is probably going to increase because people are not wasting time putzing on the bridge, right? However, there are both positive externalities and negative externalities. We had a project in my city that was supposed to be completed in 2 years at a cost of about $20 million, and it was just completed. And it's been 7.5 years, and it was about $50 million. So there are positive externalities and there are negative externalities. But the reading here focuses on the positive nature of that. All right, how about measures of economic growth? So what do we know from our discussion all along today? We've talked about GDP, right? Just the total productivity of the economy. But what if we ask ourselves the question, hey, how about if everything were perfect? What if this were an ideal world? You guys ever watch Seinfeld? Do you remember that episode where Kramer went to the New York Yankees fantasy baseball camp? So a fantasy world, so let's call this growth in potential GDP. I mean, it's not a perfect analogy. And of course, Kramer punches Mickey Mantle, and what a fantastic episode that is. So this is not a perfect analogy, and it's not a perfect measure of, what could possibly be. But let's go ahead and call this growth in potential GDP. Let's call it growth in labor, right? Growth in capital, and then growth in technology. If you sum those, and those are just plus signs there, it's additive. So we're just summing those as growth in potential GDP, which takes a look at those inputs, right? We have people and we have capital and we have technology. That's growth in potential GDP. Labor productivity, this is an easy ratio. Just take that real GDP over aggregate hours. And then potential GDP, we can just say, let's take those aggregate hours times the labor productivity. And so we can use this concept of Kramer's fantasy baseball camp to come up with some idea of what could the economy look like if everything went our way, if the businesses and the individuals, they all did the right things, if the federal government did all the right things. So measures in economic growth. Now, how about the production function? Of course, this depends on things like new technologies and the accumulation of raw materials and labor and capital. And that accumulation doesn't simply mean we're just going to throw raw materials. What did we talk about earlier? Trees. Let's suppose we're a paper mill, and so we need trees, right? This is a renewable source. We need these things, so we cut down a tree, and then we go ahead and plant 4 or 5 more. It's not just a matter of taking these trees and throwing them in the corner, but taking those trees and efficiently lining them up in the production process so there is no waste. And one of the coolest things that I've seen in my area is that we have a paper mill over there somewhere, and what they do is that they take the trees and they scrape off all the bark and they chop up all the bark and they throw a bunch of other stuff and they sell it as mulch. So raw materials are the trees, and they make 2x4s so that you can build stuff. But then, this is an extra thing. And so not only is this paper mill, they make great paper, but they also sell mulch. And so the accumulation of raw materials and labor and capital is kind of a combination of all the stuff that I'm talking about with that paper mill. All right, how about outcomes on this production function and some of these assumptions here? So economic growth is restricted by levels of input, of course. And so what happens if we have, let's just say some crazy thing happens. Suppose we have 100 workers and we have 100 units of machinery over here. And the machinery over here could be manned by, let's say 150 workers. We have 100 workers and we have the capacity for 150. Well, let's suppose that all of a sudden, for some crazy reason, we put 1,000 workers in there. So labor market is growing more than the capital market is growing. Well, if you throw 1,000 workers in there, they're going to be bumping into each other. They're going to be elbowing each other. They're going to be doing all sorts of things that are not efficient. All right. So we need to worry about the relative growth rates of labor and capital, right? So what do we have written down? If capital grows at a higher rate than labor, capital will become less productive. All right, that should make sense. The only way to maintain growth in potential per capita GDP is through advances in technology. So when you throw those 1,000 people in there, you have them looking at each other, not knowing what to do. But if you put a machine in there that requires 1,000 people, and instead of picking, what was I saying in my Honeycrisp apple example, picking 100 apples a day, this machine can now pick 1,000 apples a day. And you have all these workers in the machinery working together. All right, 2 primary reasons that cause economic growth: increase in productive outputs and technological advances. All right, so this is a good summary here. We've talked about this. So growth can be represented by the 2-factor model. So aggregate output is a function of technology, that's the A, and then that's a function, and then multiply that by labor, productivity of labor, and productivity of capital. And so that technology can be scaled in something known as total factor productivity. And so what we do is we increase those inputs. They have an additive effect on growth. So that's important. But increases in this total factor productivity, that can have a multiplicative effect on growth. And that's probably a really great exam question. Remember additive and adding and multiplication. Factors of production pretty much have constant returns to scale, but total factor productivity has diminishing marginal returns to individual outputs. And so this takes us through our learning outcome statements. Here's my take on this. It's critical to know those first four with GDP. And then it's critical to know aggregate demand and aggregate supply. If you know those two things, then I think the rest of those LOSs kind of fall into place. So my advice is to focus on those four, GDP, then aggregate demand and aggregate supply, and then just kind of fill in the gaps of those other learning outcome statements. So thank you for watching and good luck studying.